Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to talk about two different companies that are similar in terms of their business. So they both deal with the cloud side of things. They both work with some of the biggest companies in the world. They are growing their earnings very fast, and right now they're expected to grow their earnings about 20 plus every single year. These companies have a positive earnings and they're both wide economic mode companies. So I want to give you those two companies so you can do a bit more research if you're interested. Remember, all I'm doing here is just sharing my basically what I found out about these companies, and then you can do and you obviously your own research and find out a bit more about these two companies. Okay, but before we get to the two companies, I would like you to press that like button for the video, subscribe to the channel if you haven't, and join us on the Discord, where you basically if you want to join the Discord, you have to join the Patreon account. Okay, this really helps the channel and you get access to all the things that I use for basically my research and everything else, inshallah. Right, let's get started and look at the first company. So the first company we look at is ServiceNow. This company provides enterprise cloud computing solutions, okay, structure, consolidation, management, automation services for enterprise worldwide. The company operates they have something called a Now platform for workflow, automation, artificial intelligence, machine learning. There you go. That's the keyword AI these days, right? Machine learning, robotics. Okay, they basically have all the amazing stuff when it comes to the technology. I hear all of these things, I'm like, I know exactly what they're talking about. But yeah, so this company works with a lot of some of the biggest companies out there. They work with small businesses and so on, so to deal with all this cloud side of things. They currently trading $434 per share, and the year to date they're actually about 12% up. The 5-year return is about 31%, and when it comes to EPS, we're looking at $1.96. It has market cap of $89 billion. It has a wide economic moat, like I said earlier. And beta is actually not bad for technology companies, because normally they trade in more than one. So normally when we say beta, we're talking about basically if a company has a beta below 1, then that means they're not as volatile as the rest of the markets basically. In terms of PE, right now we're looking at 221, which is very, very expensive. But the forward PE is actually slightly lower, and the 5-year average, right? So this company might be overvalued right now, because according to the 5-year average, okay, 95 PE, and right now basically we're looking at about 221. In terms of price to free cash flow, we're looking at 41. So that's more or less where the forward PE is. And in terms of sector, if in comparison to the sector, we're looking at about 30.72. So it's actually way more expensive than the overall market if you're looking at it in terms of relative side of things. Okay, in terms of free cash flow, again, these companies will trade this because of the high growth side of things. Okay, free cash flow here, we're looking at about $2.14 billion of free cash flow. Free cash flow margin, we're looking at about 33%, which is absolutely huge. Free cash flow yield, we're looking at about 2.4, which is basically closer to what we're normally looking for. Profit margin was looking about 5%. Operating margin is looking about 5%. Return on equity, again, these companies have become positive in terms of earning side of things not long ago. So total return in the last basically that's not actually 3 years, that's the last 10 years, is 26%. Look at the return on invested capital, is about 4%. In terms of revenue growth in the last 5 years, the compounded annual growth rate of 31%, almost a 32%, which is very, very good. Current ratio is above 1, which is good. So that means the company has enough money to cover their liabilities in the next 12 months. And this is one of the reasons why this company is trading basically this much. Okay, and growth estimate for the next year, basically expecting about 22%, earnings to grow about 22%. And then every year after that, they're expecting almost to 25%. Because of this, a lot of basically investors are betting on this company doing well. For that reason, that's why they're paying higher multiples. Okay, that's the reason why it's trading that much. In terms of fair value, right, and simply Wall Street, they're saying it's about 0.6% undervalued at the moment. So it's very close to where it is right now in terms of price wise. In terms of Morningstar, on the other hand, it's saying it's about 28% discounted right now. They expected the price to be about $600 per share. In terms of tip rank, is actually saying about 23, let's call it about 24% discounted or upside. Basically 537 is where they think the price should be. Same goes for Seeking Alpha, 441, 24% actually upside, and according to Seeking Alpha is actually strong buy. Okay, do I agree with this? I think it's a buy, but it's very, when you look at the higher multiples, it's very, very expensive. But then you look at the growth side of it, you're not gonna find a company that's growing this much for anything less than, I don't know, 50 PE right now in the market, right? In terms of business side of it, we're looking about 98.88% in terms of business side of things. Interest bearing debt is very low, and interest bearing securities is actually very low. In terms of their earnings, the shares outstanding, you can see here basically they have been diluting. Obviously these companies are very, very well known for doing that sort of a thing, and that's kind of expected because that's how they grow the business. Instead of going to the bank and getting basically a loan, they dilute the shares, or if they want to buy another company, they dilute the shares. They basically issue more shares, use that money to finance for a new deal and so on. Right, so now let's have a look in terms of the let's have a look at these earnings, no, the revenue, sorry. Okay, as you can see right now in 2022, so 2023 hasn't finished, obviously 7.27 to next year by 8.8, and then after 10, basically almost $11 billion. So it's heading absolutely the right directions. Same goes for the EPS as well. Right, let's have a look at the next company, and that is Salesforce, a company that we've spoken about so many times before. And this is one of the companies that basically I used to own in my portfolio. Again, I've sold it recently because I was just basically trying to make room for more dividend paying companies. But it's a company that I actually still like, and I'm waiting for hopefully the things to cool down, especially with the CEO. Okay, I want to see if this company, because there was a situation with the CEO where he was basically doing all sorts of stupid stuff that I actually didn't like. And I don't like when the CEO of the company is basically getting rid of other people that work with him that actually made the company the way it is. But I feel like now, because they have changed things in the last quarter, so I'm just watching on the sideline, but I want to give you the more information about it. If you would like me to do a basically more detailed analysis of this company, let me know. But this is one of the companies, basically they have a custom relationship management systems where they work with some of the biggest companies as well as the small businesses as well. I'm currently trading $197 per share. I think I sold it around here. In terms of the year to date, as can you see, it's almost 50% up, and the last 5 years the total, basically the return is about 52%. Now looking at the EPS, just became a positive not long ago, and market cap of $189 billion. So it's way bigger than ServiceNow. Economic mode side of things, we're looking about wide economic mode, and beta is slightly higher, is definitely higher, because this company can go up and down just like that in the, in a split second. Now looking at the EPS, we're looking at this is ridiculous, almost 1,000 PE right now, but the forward PE is only 27, and then the 5-year average is 53. Okay, in fact, let me just double check if that is even the case. Yahoo Finance sometimes is a bit funny, right? So current PE, non-GAAP PE, is looking about 37. The 5-year average, we're looking about 53. So, and the sector is about 17, the average, basically the medium, right? So that's let's not use that, because 1,000, I don't think that's the case. But in fact, no, they're actually right. Okay, fine. This is what they're using. So they're using PE, the gap trailing 12 months. So that's, well, they are spot on. Forward PE is actually low, like I said. The 5-year average is 53, and the price to free cash flow of 31. So they are actually spot on. In terms of the sector, is right now about 30, but according to that, that's really, really expensive. Now, free cash flow, we're looking at about $6.31 billion. Free cash flow margin, we look about 33%. Free cash flow yield, we look about 3.3, which is basically higher than what we expected, which is really good. Profit margins, I don't think this company is there yet. Okay, so maybe in the next 5 years you will see this changing. It's becoming a mature company now. Is obviously, and it's been, I think it was 2020 it was added to the Dow Jones, and I think in the next few years you will see this company basically becoming a more mature company. When I say mature, they become the Microsoft, if you like. They're no longer high tech, high growth companies, if you're not high tech but high not growth side of things. Okay, total return we're looking about 16%, let's call it 17% in the last 10 years. Return on invested capital is obviously not there, but the revenue is actually growing massively, which is quite nice. In the last 5 years, about 25%. Current ratio is just a spot on 1, which is absolutely fine. They're expecting the earnings to grow a lot in the next couple of years. So this year about 24%, let's call it 25%, and then 20% every year after that, which is absolutely huge. And as you can see, is that according to Simply Wall Street, is undervalued about 30%. According to Morningstar, it's about 19% discounted right now. According to Tip Ranks, about 13% discounted, and according to Seeking Alpha, it's about 16% discounted, and is a buy according to Seeking Alpha. So as you can see, every single one of these analysts from these companies have actually agreed this company is undervalued at the moment, okay, and is a buy. In terms of business side of things, Sharia compliance side of things is 100% fine. About 9% in terms of interest-bearing debt, and about 7% in terms of interest-bearing securities. As you can see, this is beautiful if this was the revenue, but as you can see, this is in terms of shares outstanding has been increasing. So I'm hoping, I think they've announced a share buyback recently, so it would be interesting to see in the next 12 months this come down. Okay, and this is what I mean by becoming a mature company. This is what you want to see. The mature companies should be buying back their own shares, not diluting your own shares. So in terms of looking at their in terms of revenue and what is expected in the next couple of years, so if we go to here, let's go down all the way, you can see from 31.3 billion to basically by the end of this year, expected about 34 billion. So that's about 3 billion growth in terms of growth side of it. And in terms of looking at the EPS, you can see it's growing massively, and that's probably one of the reasons why a lot of investors are basically putting a lot of money into this company, knowing that everything about this company is heading the right direction. I hope the CEO gets his stuff together, because we need to make this is the type of business that I would love to own, and I actually used to own in my portfolio. The only reason I actually sold it was I was a bit hesitant about what he was doing. He's become a bit more celebrity. He was getting paying all these celebrities to basically do promotions for him and so on. He wasn't focused on the business, but they recently have some investors that joined the company that basically made some sort of active investors that made some changes to the company, or demanded some changes. So I want to see the next 2-3 quarters and see if things start improving. Then I wouldn't mind actually owning this company, knowing that it's about 20%, it grows about 20% every single year going forward. There you have it. That's the 2 companies that I wanted to share with you guys. Again, if you're interested in any of these companies, obviously make sure you do your own research. Join us on the Patreon account if you can, because that really helps the channel. Like I said at the beginning, have a wonderful day. Assalamu Alaikum.